Hello everyone, welcome along. A little bit different. Tonight is another one of the sort of special topic webinars, and we're going to be getting into CoT data. What is the commitment of traders specifically? So what are we going to be looking at tonight? What is the commitment of traders, as I say, the traders that we can see in it, the players, etc. Then we're going to be looking at the main reports, the different types of reports, and typically the main report I look at is what's known as the legacy report. We'll look at who we should follow after the legacy report, whether it's with commercials or speculators. Then looking a little bit at how to read it correctly, and that'll be very useful for people, some of you that have never looked at it before. So let's start off. What is the commitment of traders? Commitment of traders is a report provided by the CFTC, the Commodity Futures Trading Commission in the US, and it is the only record of buying and selling activity that is available to traders. The reason why there is that record there, it's taken from the futures market and it's going through the exchange. So there is an actual record of everything that happens. And certain traders have to register themselves and actually stipulate what they're doing and how many positions they're holding. And they have to do that every week. The report is released every Friday, and it details every long and short position that is still active in the market. The still active bit here is really important. So that means essentially the intraday positions are therefore not included. You will have lots of volume traders, intraday traders that are in and out, and they can cause movement within the market certainly, but they will not be included within a CoT report. Intraday positions have already left the market and can't impact it any further. Think of CoT positions typically would be more in line with an end of day position, or what you guys would understand as an end of day position, but typically most positions that we can see in the CoT report typically actually last a lot longer than that. They're looking for weeks and months, so some of them are sitting into. The reports, there's multiple reports actually, but the reports categorize each trader into groups, and they look at his or her positions based on their purpose for being in the market. This purpose is very, very important. The purpose, i.e. the two main purposes, whether are you in the market for business purposes or speculation. This is probably the most important element when it comes to trying to understand CoT data, is understanding these two groups, and it's what causes a lot of confusion for people. And we will certainly get into these two groups in more detail. Anybody ever been on the CFTC website? A few of you? It's quite a boring place to be honest, but we'll take a quick look. But here's essentially, this is an image taken from the homepage of where the CoT data is, and an actual example of what you're going to get. So this is the data what you would get direct from the CFTC. I'll just pop over and actually take a look. I just go on. This is the homepage of CFTC. Go into market data, commitment of traders, and you'll be presented with that, as I said, from the image. Scroll down, you'll see lots of different reports, and go to the bottom. Say that example we just seen on CAD. I click on that. There's the CoT data that gets released every week. So the CFTC definitely they go to great lengths to collect data, and they don't go to great lengths to give it to you in a way that you can actually do anything with it. There's each market. There's random length lumber. That's the breakdown you would get for that market. Scroll down a little bit further, you'll start to see some more familiar markets. There's this British pound, and within that you can see there's non-commercial, commercial positions, the number of long, the number of short. So it's not the most straightforward of data sets. As I say, they definitely concentrate on trying to get it. Of putting the data together as opposed to giving it to you in a way that we can actually use it. So that's what you get if you go to the CFTC, and there are the providers for it. It's not user-friendly at all when it comes from the CFTC, as we just seen. And I think for me, it's one of the main reasons why the data isn't more widely adopted by, especially among retail traders, institutions and funds. You'll see often many reports from different funds and institutions that have been using it for years, but they have the knowledge, the resources to break it down, because everybody essentially over the years has broken it down themselves into a usable format. As a retail trader, your only real options is to break it down yourself in Excel, or an Excel, there's obviously multiple ways you could do it, but in Excel, or use a third-party service like ourselves that'll break it down and do it for you. To give you an example, I actually used to do it in Excel. This is an Excel sheet I created. It must be 7 or 8 years ago now, originally, whenever I first started looking at CoT data. And this is the Excel sheet that I used to use. This is all the CoT data that's downloaded. We download it every week. And then this is all the calculations that was required All of these calculations are required from that data, and then I would make these graphs. And these would update automatically every week. It was a hugely painstaking operation, but I did that every week for quite a few years, actually, before then looking at putting it online. So you can definitely do it yourself. That is one of the options, but there is a lot of work included. But I still keep that, actually, and I still use it for analyzing and testing. So yeah, not many options as a retail trader. Any of the institutions and funds over the years, they typically use it in-house, and you'd get reports and stuff you'd see online, but the actual workings out, the breaking down itself, would be used in-house and kept in-house. So it wasn't particularly easy to access for retail traders. And there's a few services that have been around for a few years, but I struggled to use them, hence why I created Markets Made Clear in the first place. Say, before we look at the actual data and how it's broken down, let's take a look at a few to try to understand the traders themselves that's included. How do I actually see in the CoT report what's actually the breakdown, and what can we actually see? Typically, as I said, CoT report breaks down each trader into two separate categories, whether they're for business purposes or speculation. But if you do a quick Google search, I'm sure some of you will have done this, do a quick search and you will find that there are many different groups. You'll probably start to see, if you haven't seen all of these, you'll have seen quite a few of them. Commercial traders, producers, swap dealers, non-reportables, asset managers, leveraged funds, users, etc., etc. It can get a little bit complicated, or seem a little bit complicated, and you start to wonder, well, who are all these people? And effectively, actually, it's all terms used to describe the same position. It's just, unfortunately, in different reports, certain traders are recategorized. So they're counting the same positions in multiple times, but it's on a different report. There are three main CoT reports, and this only increases the confusion even further, unfortunately, for retail traders. We've got a few explanatory notes on here. Actually, I meant to say I will give this out, this handout, this presentation. I will give this at the end. Remind me, somebody, to actually just stick it up at the end, and you'll see all these links are clickable whenever you download, and you can read through it yourself. So yeah. Okay, so yeah, it's the same terms used to describe the same positions, and it's because there are three main reports. You've got the legacy reports, the traders and financial futures, otherwise known as the TIF, and the disaggregated reports. The legacy report is the original report that was created, I can't remember, it's back in the 60s, I think, and it's still the most widely referred to, although you're starting to see a lot more follow in line with the disaggregated. The CoT example we've seen earlier is taken from the legacy report. The disaggregated reports was created to improve transparency. They further introduced different subcategories, as we just seen from the other slide, all the different names. And the traders and financial futures was put in to better represent financial markets, because we don't have producers and users, etc. in financials. So nobody produces. Well, I was going to say there's nobody producing the euro and the pound, but you could argue that somebody is. The printing press has never stopped, but as in producers of an actual product, something you can dig out of the ground, for example. Okay, that's why we typically get the same position. You might see a position in the legacy report where somebody's buying gold or buying pound, etc. in the legacy report, but then it gets recategorized as a different person. So somebody that was a commercial in one could be a dealer in another, or a producer in another. So it gets a little bit complicated, but the three is actually the same thing. So the easy way to remember it, I've put together a bit of a cheat sheet here if you are ever looking at the different reports. The legacy, the two main groups are, you've got your commercial and your non-commercial. Your disaggregated report, which will be all your natural markets, anything you can create, take out of the ground, etc. You're going to have your producers and your managed money. You're going to be the two main groups, and then the traders and financial futures, TIF. The main groups are dealers and leveraged funds. The new reports provide a little bit more transparency, but I've done some testing. I've done a lot of testing in Excel. I don't see any significant trading advantage by using these are much more recent reports, looking at sort of 2000, maybe about 10 years of history, maybe 12 years of history, and those were as opposed to the legacy data we are looking at 50, 60 years in some markets. So we don't have as much history with these, and that's one of the main reasons why our website still uses the original legacy reports. It's a lot easier to do back testing with. You've got more to work with, and it's much easier. And plus, all the markets are contained within the legacy report, whereas if you're going to use the other reports, you have to use both of these. Okay, so it's a little bit more straightforward to use that. In time, possibly I will change over as we get a little bit more history, and you may see markets evolve and get a bit more of an advantage from using these. But at the moment, I will remain at the legacy. Okay, so we're going to be looking at the legacy reports from now on in detail. The legacy report breaks down CoT data or traders included in the data into three main groups: commercials, non-commercials, and non-reportables. Commercials describe an entity involved in the production, processing, merchandising of a commodity, essentially using the futures markets primarily for hedging. They are not using the markets to make money. They're making money from the product or the item itself, and they're using the markets to offset risk, etc. That's the main difference to this group. Non-commercials, your large speculators, your banks, your hedge funds, institutions, etc. like that. Their main difference is they are using the futures market 100% for speculative purposes and looking to make money directly from an increase or decrease in the value of an asset. Simple as that. That's the main difference between those two. The non-reportable small speculators, typically small non-commercials, so typically the same as this group, just below certain reporting levels. For example, if any of you guys want to trade on the futures market, you would automatically be put into the non-reportable category. So typically small non-commercial traders, but it can contain some small commercial traders. You will actually see some small businesses that also using the markets. So that's why generally there's no consistent theme from the non-reportables, but generally they're more often than not on the wrong side. But there's not great signals. Apart from some of the agricultural markets, actually, you'll actually get some well-informed, actually, farmers using the market, and they will be in here, and you'll actually see sometimes they're actually very well-informed, and you can get some good signals from them. The meat markets, for example, your lean hogs, live kettles, things like that, can actually be some good signals from them because they are very well-informed about what they're doing. Okay, it is important to understand each of these groups. To say we'll be concentrating on these two because this is where the money is, between the commercial and the non-commercial. But it's important to understand the two groups and what they're doing in the market, because it helps us understand what their positions are telling us. So who should we follow is the question I get asked all the time, non-stop. Anytime I'm talking to especially newbies about CoT data, who should you follow, non-commercials or commercials? To understand this, we must be able to, or to answer this, you must be able to understand how each group is operating, as I was just saying. I think it's the most complicated. It's certainly the element that most people tend to struggle with when it comes to CoT data, because they struggle with the conflicting data. One group typically will be, if one group's selling, the other group will be buying. So how do you use that? So if there's always a buyer and a seller. So how do you ever get to make a decision if there's constantly a buyer and a seller on each side? And we'll get into that. It's by understanding of what they should be doing at certain points in time within the chart. To say it is a key thing when it comes to looking at CoT data, is to know and understand how each trader should be behaving. If we can understand how each group should be behaving, and then try and trade in line with that behavior, that's whenever what appears to be conflicting data actually makes a little more sense. But we'll see that as we're going through. So to try and understand the behaviors of each of the main groups, the commercials and the non-commercials, we're going to take a look at a little bit more details just to try and help you understand those. So we're going to take a look at non-commercial, the speculators first. Starting with these because obviously this is how most of us are typically going to be trading. We're going to be trading in line with this group, so that's going to make sense to start with them, and it's the group that most people tend to understand a little bit easier. So non-commercial speculators, they use the market for 100% for speculative purposes. They will buy a market as it rallies, and they will sell it as it declines. Pretty straightforward. That's exactly if a market's in an uptrend. Yeah, market's in an uptrend, you'll be looking to buy. If a market's in a downtrend, you'll be looking to sell. Here's an example of pound taken from the website. This is a weekly chart, so we're looking at fairly long periods of time here that we've got movement. You can see this movement to the downside through here over several months. Speculators, as we're in a downtrend, You can see they're more interested to adding to shorts. Sorry, I'll explain at the bottom. At the bottom here, these two lines, the green line is the number of long positions, long contracts. The red line is the number of short contracts. You can see the number that will reflect where we currently are sitting. So you can see as the market declines there, they want to add more on the short sides. They're selling more, they're increasing their shorts, and they're building up significantly. They're going from around 40,000. You can see there's 2 lines of 50,000 contracts and 100,000 contracts. They're going from around 40,000 contracts up to 100,000 contracts. So well over double of what they were selling up here, they're selling down here. So they want to add into their shorts, and they're going to decrease their longs. They're not interested in buying this market as it comes down. On the other hand, whenever it starts to trend up, you're going to see the opposite. They're going to not interested in selling a market when it rises. They're cutting the longs, or cutting the shorts. Sorry, you see the red line declining steadily as we move across, and then they start adding into the longs, and that continues to steadily cycle as the market cycles up. So that's very straightforward to understand. Here's another example of the euro. You can see the downtrend we've got through here. As the market trends lower, they're going to increase their short positions, and they're not going to be interested on the buy side. Speculators buy a market as it rises, and they sell it as it falls. In an uptrend, as we just seen there from the pound, long positions should increase while shorts decrease. And as say from the example of pound, we can see that long positions are increasing, the short positions are decreasing. There will be times, however, where the long positions do not increase, but price is increasing. This is an indication that the trend is weak and a correction is near. Your major warning for an uptrend is if they are actively cutting long positions. Big correction is coming. We've seen a recent example of this in the euro. If I just go in, let's take a look at that actually, just to give you a better understanding. Let's look at the euro. There's the euro weekly chart. Now, what we're interested in the non-commercial. We're looking at the non-commercial traders here. So what we're looking at and what we're saying, major warning for an uptrend is if they are actively cutting long positions. So they're no longer buying an uptrend. They're cutting the long positions. Okay, so you just think of the logic of that. We're in an uptrend, and trend followers, the ones that are trying to drive that trend and are jumping on the bandwagon, essentially, they're actually stopping to do that. Yeah, so you're sort of taking the fuel out of the fire, and that's exactly what we got in euro towards the end of this move. This is the just to confuse you, that's the CoT index. We're not going to look at that for a second. That's the commercial data, and it's the non-commercial data. We're going to concentrate on this section on the non-commercial. So we just turn the shorts and the longs off. You see the trend, big uptrend all through here until we got to the high just here. Throughout that period, all the way up, we've seen the speculators buying as the trend moved higher, only for right at the end, right at the peak on that little inside day there, it's a weekly chart, inside week, they actually cut. And that was the first indication that they were getting tired of this uptrend, getting a little bit worried from it. There was other signals coming on the other side from commercials, but I just want to focus on that. That's a major signal. If the trend followers are no longer buying an uptrend, it's a really big indication that the market is going to struggle to move higher because you've got nobody else to drive it up. Euro remained in here. After cutting the held pace for a little bit, but eventually the weight eventually told, and you've seen the market roll over. It took a bit longer than what I would have expected after we've seen that, but that's a major negative to any trend, any uptrend. To see that, and a downtrend, obviously, to see actively cutting the shorts, it would be another. Okay, does that make sense? Yes. So that's a major signal to look out for, and it would, of course, would be the opposite for downtrends. Now let's look at business. This is where typically most people get a little bit confused because they typically do the opposite of what we would do as traders, especially when we're looking at trend. They will do the exact opposite of what we've just seen the speculators doing. Business, because they're in here for business purposes, they will buy cheap and sell expensive. It's sort of the old adage when it comes to buying stocks, etc. Buy cheap, sell expensive, but that's typically not when we're actually trading trend, we may trade or buy relatively cheap and sell relatively expensive, but we're trading the much smaller cycles. Business will do it on a much larger scale. The complete opposite what we just seen from the examples of speculators. You'll see as the price actually rallied through here, this is the chart of gold, a weekly chart of gold. As the chart actually rallied, they want to sell more. They're interested in selling it. They're not interested in buying in this. As it rallies, they're interested in selling it. You can actually see they're cutting the long contracts. They're dropping down steadily, whereas they're increasing the shorts quite quickly. Yeah, and you'll see the opposite here is we actually trend lower. They're not interested in selling it as it gets cheaper. They're interested in buying, and you'll see the long contracts steadily increase. So they will do the opposite, and they will continue to do it as the market gets cheaper or more expensive. Here's another example in copper. Price of copper is getting cheaper. Price is going down, and they want to buy more. And you'll see very, very sharply cutting the amount that they're selling. You think if you own a market, if you own a product. I use the example if you had a shed full of copper, you're not going to be interested if your copper was worth. If you had a shed full of copper and you had £100,000 sitting there, and now it's only worth 80,000, you're not going to be selling it for that price. You're going to hold off. But if you're going to possibly buy in more for selling on later because you think it's relatively cheap, you will be buying more. And that's to try to think of the mindset of what business is actually doing, because it tends to confuse a lot of people when they look at the CoT data. So business will do the opposite. As I said, they will look at a market and they will sell a market as it rises and buy it as it falls. In an uptrend, short positions should increase while longs decrease. If longs are increasing as price also increases, then the trend is set to continue, and they believe it's going to continue as well. Major warning for an uptrend is if they increase selling at a faster pace than what they've been doing previously, and they're sharply cutting long positions. A big correction is coming. We'll take a look at a couple of examples of that in a minute. So once we can understand those two groups, we now have a better understanding of who we should follow. And the simple answer is neither group can be ignored. You'll see if you look online, if you read a lot of reports on different typical retail trader websites, they typically refer to speculators because they're trying to align themselves with them and they feel that they're in line with them. But typically the commercial traders actually account for about 60% of all markets. So that I would never ignore that group. There is a time to align yourself with one or the other. Okay, and we're going to look at a few examples in a minute of when those times actually are. So know that neither group should be ignored. You've got a huge amount of data that's coming through from the CFTC in these reports. So I never understand why anybody would actually ignore that section of data and just focus on this. They complement each other very well, and if they understand both groups, they're actually quite easy to understand. Start by thinking of each group's positions in the context of the chart. Yeah, if you are new to data, if you're completely new to data, look at a chart first and then try to understand what should each group be doing at this point in time. And that typically makes it a lot more easier to understand rather than looking at the data first and just going, oh, they're buying more or they're selling more, etc. And then trying to make a decision based on that. Look at the chart, try and understand what they should be doing, and then use that information to help you base your trading decision or what you want to do based on that market. So look at each group's positions in the context of the chart. How should each group be behaving at that point in time when you take the context of the chart into considerations? Do their actions fit with a continuation of the current chart pattern, or are they changing? The euro chart that we just looked at, for example, do their actions fit with a continuation of the current chart pattern? We were in an uptrend and they stopped buying. So no, it didn't fit with the continuation of the pattern. Their behavior was changing, so that uptrend was getting weaker. Do your plans then align with the actions that we're seeing in the data? Most of us would have been looking at the uptrend, the weekly uptrend of the euro, and identifying that we are in an uptrend, we're in a weekly uptrend, we're in a daily uptrend, we want to buy. As I say, the data can show us whether we're right to be thinking of taking positions like that, or if actually something is happening behind the scenes that we typically cannot see without looking at the data. A good example of that perfect typical behavior that we see from each group is platinum. Actually, we'll take a look at that. It shows you a really good example of what each group, because it's textbook of what each group should be doing. We take a look at platinum. The platinum weekly chart again at the top, and you'll see we've had a strong decline over several months actually. So let's look at the commercials first of all. So business up through here. I'm going to turn off the net position. The blue line is the net position. I'm going to turn that off on both, which I typically do most of the time when I come on. I'm generally more interested in the actual shorts and long positions themselves. So let's start with the long position. So the market is declining. Business is going to be buying. Yeah, business is going to be buying. The market is getting cheaper. They're going to be interested in buying more, and that's exactly what they're doing. They will be cutting shorts, as we said in the example, they'll be cutting shorts, and exactly they are. As the market declines, they are not interested in continuing to sell it at those prices. The number of short contracts will decline. You'll see we've declined down to a very low level that we haven't been to for a while. Okay, so the businesses are doing exactly what you would expect them to be doing based on that chart. If you look at then speculators, they're going to be the exact opposite. As the market declines, the trend followers, the market declines, we're in a downtrend. This is a long period of time. It peaked out at January, end of January this year. So we're beginning quite a downtrend through here. So they're not going to be interested in adding to their long positions. They're going to be cutting their long positions as the market declines, and they're going to be adding to their shorts. Okay, adding to their shorts, and indeed they've added to the shorts to a level that we haven't seen again for quite a while. So that's a typical example, our textbook example of what each group should be doing based on how a market should be moving. So try and look at a market first and understand what each group should be doing, and then align yourself with whatever position you want to be taking. Really good example is to say I'm going to be giving out these notes afterwards, so you can go back through and you can go onto the data yourselves and go over it. But Platinum's a really good example of how each market should be moving. Typical behavior, but we've seen how the behaviors can change. As we've seen in the euro example, the behaviors, the non-commercials stopped buying, etc. So it's not just the typical behavior that we're looking for, it's changes in behavior and how knowing what they should be doing at any given time, whether they're doing it or not doing it, can still give us a trading decision, if that makes sense. Yeah. So how do we read it correctly? To read it correctly, we must understand all of the data, complete data, as I say. That's why I personally will never recommend to neglect or ignore any element of the data, whether it be commercial or non-commercial, regardless of what your purpose is for being in the market. I would never ignore any side of it. Unfortunately, there is no one way to read the data. As I say, it's all about the decisions that's been made by thousands of traders and the behaviors and the different patterns that we can see within those behaviors. But the behaviors change. So there's no one consistent pattern that would make trading very, very easy if it did. But that doesn't mean we still can't use the data for trading. We can see the behavior, we can see the patterns and see how they change. Say, again, the euro is a great example. As long as we understand the behaviors of each group, we can use that to base our trading decisions. Commercial traders on average control about 60%. Depends on some markets 50-50, others is actually 70-30. It depends on the market, but generally the commercials will control a larger percentage of the trading activity that's going in that market. So therefore, they control its price effectively, and that's why I will typically always start by research into a market based on what they are doing. I'll start with the data for the commercials, and then I'll look at the non-commercials as well. Non-commercials are speculators. They don't really think of it essentially. They don't care about the price of gold. They don't care about the price of wheat. They're there to make money. They're simply they're looking at fundamental data to try and work out whether they think placing a bet essentially whether I think a market's going to go up or down. So they're looking for momentum, they're looking for trend, fairly straightforward. So as a trend is there, they will try to continue that trend, but at the end of it, they will be on the wrong side. Okay, and that's why using both is really, really important. So to try and understand and use the data correctly, what I would recommend to try and start by doing is allow commercial traders to set the market's value. They own the products, essentially, the gold products or the wheat production, et cetera, et cetera. They own these products. They're involved with the distribution, the handling, everything to do with these products. So they are much better. They have much more information when it comes to actually being able to set a realistic price for that market at that given point in time. The price, the realistic price, will change over time, but at that point in time they will know a lot more information for it. That's why I start with the commercials. When you're looking at CoT data, try and look at historic commercial levels of buying and selling that we've seen that have caused the market to turn in the past. Then between those points, look at the non-commercial traders in between the buy and sell zones effectively that the commercials have placed. You can also use a CoT index, which we'll take a look at in a second, to try and identify these levels. Okay, so what do I mean by that? What do I mean by allow commercial traders to set my market's value? Let's take a look here at this is a chart of cotton. You'll see the price. There's the price chart at the top. You'll see the prices at declines, but you'll typically see this is the number of long contracts at the bottom. You'll see the 3 points are very, very similar. Notice how they've effectively set the value. They've stepped in and they believe this is at the point where now it's fair value and it's cheap to buy, and they want to buy more. So you'll see, even though the price is actually different from here to here, you'll actually see them buying the same amount. So they've stepped in and they've set this as fair value for this market. Another example here in gold, you'll see the number of short contracts that are actually in play. Typically that's 300,000. You might be able to see that on the webinar or on the camera, but that's 300,000 contracts in gold. You'll see we cross over 300,000 contracts, and that typically is enough to drive the price of gold lower each time. To say the relative price changes over time, but each time they're perceiving this is expensive for that market and they drive it lower. So that's what I mean by allowing commercials to set the value of a market, and then looking at the non-commercial positions in between these points to trade the trend. Okay, and I say typically looking at the type of cycles we're looking at on CoT data are fairly significant. We're looking at months, and I say that's why this is looking off of a weekly chart. So we're looking at big time spans and quite significant trends in between these points. Okay, I referenced that you can use a CoT index to try and help you understand the data, or try and help you understand this value, this fair value that the commercials are setting. CoT index, it helps you accurately compare buying and selling levels rather than going in and looking at all the charts, looking at all the CoT data and analyzing every buy and sell to begin with and comparing. It takes a bit of time. The CoT index actually saves a little bit of time in that. You can do about I'll not go into the calculation or all the workings out of a CoT index. There is a page on our website actually that explains what a CoT index is. It will be, if you go into here on the user guide and go into that. I'll not go into that in the webinar. But it's essentially it just speeds the process up a little bit and allows us to quickly identify the sort of then set those buying and selling levels. If the index is rising, commercials are buying more than they are selling. If they're falling, if the index is falling, they are selling more than they are buying. The indexes allows us to, as I said, to view trading activity on a relative basis, so we can quickly determine if traders are bullish or bearish on a particular market. A lot of people refer to a CoT index as being a buy and a sell signal. They're not buy and sell signals in their own right. I disagree with this. They can indicate signals, and if you dig a bit deeper, there could be a signal from it. But them in their own right, I don't recommend using them as a signal to buy and sell. The index is on a percentage scale, and it ranges from 0% to 100. 0 typically being extremely bearish, and 100 being extremely bullish. Let's have an example here in the Australian dollar. You'll see, rather than having to get into and looking at all the positions, we can actually see a CoT index ranging from 100% and 0%. You'll see we move quite quickly, and they typically coincide with fairly significant tops and bottoms. We'll take a look at a live chart in a minute. This one's going back a little bit. I have this image, but you'll typically see the index reaching the 100%, which is a bullish signal, and 0%, which is a bearish signal. Okay, if you are going to use this, if you're using the CoT index to be as a sort of a high level filter, for example, to try and understand where, or try and find out if a market's over or undervalued. Use it as a starting point, but do not just simply look at this and go, oh, it's time to buy. Drill down, as I say on here, use it as a starting point, and then drill into the positions. Are they actually buying a market as they should be down through here, or are they just not interested in selling? The two of them very, very different. Let's take a look at Aussie. Actually, let me just open up the Aussie. This is the current Aussie chart, and you'll see the index at the top through here. We're actually been up here quite recently, and we are sitting about 100% at the moment. And we have been, so typically we are close to bottoms whenever we're at 100%, and we're typically close to tops when we're at 0%, but not always, because we need to actually come in here and see what is driving this. Are they buying? Are they selling? It's driven off the commercial positions. By the way, I don't know if I said that. It's driven off the commercial positions. So we're typically looking for to help us set the value. Over here, up here at 100%, they're typically, the commercials believe a market is undervalued, and out here they believe it is overvalued. Let's have a look at the short positions. You'll see whenever they typically believe a market is undervalued, they will not be selling. They will have no interest, because we'll already have come down, and they will have no interest on the sell side, but they will increase the longs instead. Yeah, they will be buying as it declines, sometimes more sharply than others. As we stand at the moment, we're at 100% on the index, and the buying, if we just focus on the buying for a second, the buying is indeed at the highest level we've seen for quite a while, which would indicate a rally is not that far away, or at least this decline, or any further decline, would be very, very limited. You can see a point here where we've been bullish in the past with a slight little further drop and then turned around and got the rally. So we can do that. Unfortunately, CoT data, we can't use it. It's not a timing tool. Just because we reach 100% or they're doing a lot of buying, that doesn't mean they have to go up instantly the following week. It's not a timing tool. It sets the conditions in the market. It helps us determine whether a trend will continue much further or not, or possibly how strong that trend might be. But we don't know exactly. We can't work out to the day or the hour. Definitely not the hour, when a trend or a market's actually going to move. So it's not a timing tool, but it sets the conditions in the market. A lot of people assume it's a timing. Just because we reach 100, we now should go up. Unfortunately, it's not the case. We take the information on board as traders and try to work out exactly where the likelihood is, where the impact of these positions, where they're likely to take most effect. That's where we use our normal technical analysis for when it comes to those places. But you can see there typically how the index aligns with the tops and bottoms, but not always. So that's why we want to be looking at the positions, actually drilling in to the longs and the shorts positions, because at the bottoms we don't want them to be selling. No interest in selling at these points. We want to see the selling reduced. At the lows, we want to see the buying increase, and then obviously the opposite on the for the highs. Okay, so yeah, to try and save time, by all means, use something like a CoT index. If you're all getting the data through our website, you'll typically see the CoT index whenever they're within the 100 or the 0. That's whenever they're colored. That's what the colors mean, actually, just to make it easier to find. You'll see quite a few of them we've got at the moment across our currencies. So you can use them as a starting point to try to drill in, but them on their own do not mean buy or sell. They do not mean buy or sell. We need to come in here and actually look at the data and the raw numbers themselves. Okay. Key points to remember: there is no one single CoT signal. Quite a tongue twister. It wasn't when I was writing it. There is no. You heard people. Often get emails, people saying, "Oh, there's a perfect CoT buy, there's a perfect CoT sell." There's certain conditions you want to see at certain times, yes, but it's all about the behaviors, and there's too much data in there to try and break down and just say there's one single element. We need to look at both commercials and non-commercials. You may align yourself. You may see it depending on your own style. You may find yourself aligning with one or the other. If you're a trend follower solely, if you're using time from correlation and your dailies and your weeklies must be aligned, etc., etc., you will find that certainly you're going to be aligned with the non-commercials more often than the commercials. But even if that is the case and you are trading like that, you will still need to be aware of what these guys are doing, because these guys are going to end that trend. They're going to end that trend. If you actually are quite interested in trading reversals off levels and big swings on weekly charts, then you're probably going to find yourself more often than not aligning yourself with these guys. Because if we've been in a weekly downtrend and you're looking to try and buy that dip, buy off a strong level of support, for example, then the only people who are going to be buying that will be commercials. It won't be the non-commercials. But you may see occasional changes in behavior where you'll actually see the non-commercials. You may see the occasional period where we've got actually non-commercials buying into a downtrend. There's a really good example of that last year in copper, actually, where over a sustained period, multiple year downtrend in copper, the non-commercials actually started to realize they were very much on the wrong side of the fence, and they started to actually cover themselves by buying into it before it turned. So there's still behaviors there that we can see, but you certainly will align yourself with one group more often than the other. Do not make trading decisions using net positions. I see on different social media platforms, whether it be Facebook, mostly Twitter and things like that, where you get a lot of traders posting things saying such a trader is net long or such a trader is net short, etc., etc. That in its own right doesn't actually mean an awful lot. Means very, very little, because you don't actually know what's created that. So don't base it. Certainly do not give you an idea of whether you're buying or selling activity going on, but it's not something you can use to base trading decisions on. As I said, you'll typically, whenever I'm on here, I actually typically turn the net position. There is a net position there. I actually typically turn that off, and actually don't want to see the long on the shorts on what's going on. So if you're using CoT data, don't use net positions for actually making decisions. Look at the actual buying and selling activity on the whole, rather, as opposed to the difference between the two, which the net is presenting us with. Use a CoT index. Try and help save you a bit of time. That will help you determine whether the market is over or undervalued. But then drill down and examine the buying and selling levels to see if there's a turning point coming. If we may have reached 100% or 0%, there may not be a turning point whenever you go and actually look at the buying and selling levels themselves. Okay, so in summary, generally what we're doing, so if you want to sort of break it down into sort of simple steps, use the CoT index grid. It's called the CoT index grid on our site. Use that section to try and find markets that are over and undervalued by commercials. Then go in and check long and short positions to see if they've reached turning points. Pay very close attention to commercials at these levels, and then speculators in between times. So we went from an overvalued to an undervalued. We can trade in line with the speculators in between. But be aware, always be aware, and look out for subtle changes in the behavior of the positions as it changes, if there are any changes in the character. That euro is a really good example, and you see that's quite common actually. The pound commercial, or speculators in pound did it last year. Did it in Kiwi as well. So we did it in copper. So it's quite common that you actually see these speculators also give very, very strong signals that they're tired of a trend. Said tonight, I just want to try and get everybody up to speed to try and help you understand the data itself, rather than getting into too much detail of all the raw numbers. I'll save that for later webinars. There's certainly a lot more we can go into. As I say, there's quite a few elements on the site that I haven't mentioned. These numbers like percentage change and extremes, etc., and the various index numbers themselves. But I just wanted to use tonight to try and get everybody up to the same speed to try and understand the data itself. And the main point when it comes to understanding CoT is each group. What is each group doing at any point in time? How are they positioned? Why are they positioned the way they are? And that's by understanding their purpose, the business purpose or the speculative purposes. And that was the main purpose of tonight, to try to get the mindset right, and then it's much easier to try and understand. Any questions? Say I wanted to keep it. Well, I actually thought it would be briefer than this. I actually went on quite a bit, but say the main purpose of this was just to try and understand the groups. If you can understand the main purpose between business and speculation and why they are buying and selling, then the data doesn't become confusing. You'll understand, well, they should be buyers at this point in time, and they should be sellers at this point in time, and their actual, what appears to be conflicting actions makes perfect sense, because that's what they should be doing. So that's the first point we try to understanding CoT data. Once you get that nailed down and actually understand those two groups, and their behaviors, then all the numbers actually make sense. And it's really easy actually to break down the data. In later webinars, I will go into more detail. The next one I want to look at is actually how to use the data to try and trade multiple markets, whether we trade correlated markets, stocks, individual stocks, and things like that, and different ETFs and stuff. So we'll look at how they break down the numbers a little bit further in a little more detail. But hopefully tonight just got everybody to the same point. We can build on from that. Okay, guys. That's all from me. Thanks very much for joining in. Any regulars that are with me, you'll know I'll be online again on Monday. Any newbies that haven't been on to any of the MMCTV before, we'll be doing a Monday webinar where we'll be looking at live analysis. So we'll be back on Monday, 8 p.m. UK for that. If you want to join, I will see you all then.